I'm Daniel.
And I'm Mira.
Imagine waking up to a world where, where a major global trade artery is just physically choked off. And on top of that, the Federal Reserve is actively threatening to keep interest rates painfully high, and surging inflation is just staring you right in the face.
Yeah.
Logically, you would expect the stock market to absolutely crash.
Oh, yeah. You'd expect total panic.
Exactly. But today, the market looked at that perfect storm, and it did the exact opposite.
It completely defied gravity.
Yeah.
I mean, honestly, it
Yeah.
forces us to question everything we assume about how the real economy connects to the financial world. Because usually when the physical world is hurting, stocks reflect that pain. But today, they just completely decoupled.
It's wild. So the mission of our deep dive today is to untangle these market drivers for you for Friday, May 1st, 2026. Because the narrative unfolding right now is, well, it's truly historic. We're going to explore exactly how U.S. mega-cap tech stocks and this massive AI infrastructure boom somehow managed to hold the line against an absolute gauntlet of bad news.
Yeah, and we're talking terrifying stagflationary data, a deeply hawkish pivot from the Fed, and severely stalled ceasefire talks in the Middle East. It's a lot.
It really is. Now, before we get into the weeds, we just want to clearly state that this deep dive is strictly for market context and discussion. It is not personal investment advice or, an investment recommendation.
Right, exactly. We're here to analyze the board, not tell you how to play your pieces.
So what set the stage before the U.S. session? Because all this chaos, it didn't just start at 9:30 a.m. in New York.
Not at all. I mean, to understand today's bizarre market action, you really have to remember the hangover investors were waking up with from Thursday's prior session. The macro stage was already highly pressurized. We had just received a hot 2.0% advanced GDP print, and much more importantly, a 4.3% core PCE inflation print.
And that specific combination is just toxic, right? Because it means growth is sluggish, but prices are still rocketing higher.
Exactly. It left global markets incredibly sensitive.
Yeah.
Investors were essentially walking on eggshells overnight, just waiting for any kind of new inflation or energy shock.
And unfortunately, the market got exactly what it was terrified of. After the prior U.S. close, late Thursday evening, around 5:28 p.m. Eastern Time on April 30, major reports broke regarding the Strait of Hormuz.
Right. The new peace proposal.
Yeah. Iran reportedly handed a brand new peace proposal to Pakistani mediators. And the offer was incredibly specific. It included a long-term freeze on nuclear enrichment via technical committees, but, and this is the big but, it completely deferred any discussions about arms issues to a later date.
And almost immediately, former President Trump came out publicly to reject the terms, explicitly stating he was, quote, not satisfied.
Yeah, and you can see why the market immediately gets nervous looking at those headlines, right? The reflex is to view this as unpredictable, sort of irrational geopolitical chaos. It feels like a powder keg with a lit fuse.
Oh, absolutely. People see 400 commercial ships physically trapped in the Strait of Hormuz, and they just see senseless destruction of global trade. It feels random to a lot of traders.
See, I have to challenge that reflex, Mara. Everyone calls it chaos, but if we look at this through a game theoretic lens, it's the exact opposite of random. It is highly calculated.
Okay, how so?
Well, Iran physically trapping roughly 400 ships in one of the world's most critical oil choke points is maximum leverage. It is a calculated physical chokehold on the global economy. And on the flip side, the U.S. demanding strict amendments regarding bombed nuclear facilities before agreeing to anything, that is a calculated countermove.
Right.
Neither side is acting irrationally here.
Right, they're negotiating.
Exactly. They are negotiating, but instead of doing it in a boardroom, they're doing it by squeezing the world's energy supply.
Which is a brilliant way to understand the tension, Daniel. It's a massive high-stakes transaction playing out in real time. And that economic chokehold has immediate, severe global ripple effects, especially when you consider how tightly wound currency markets are right now.
Yeah, let's talk about that, because while all this geopolitical tension was simmering overnight, the foreign exchange market was hit with a sudden, violent shockwave.
Yeah, at 8:06 p.m. Eastern Time on April 30, the data pointed to a massive, suspected foreign exchange intervention by the Bank of Japan, estimated at a staggering 5.4 trillion yen.
Which is a mind-blowing number.
It really is.
Yeah.
To understand how massive that is, we need to look at the mechanics of what the Bank of Japan is actually doing. When U.S. interest rates are high and Japanese rates are near zero, capital naturally flees Japan for the U.S. to get a better return.
Right, which crushes the value of the yen.
Exactly. And when your currency collapses, importing energy, which Japan desperately has to do, becomes impossibly expensive. So to stop the bleeding, the BOJ literally steps into the open market, likely selling off billions of US dollars from their foreign reserves and aggressively buying their own currency to artificially create demand.
They essentially dropped a 5.4 trillion yen bazooka into the market to prop up their money.
Yeah, and it worked, temporarily. They forcefully pushed the US dollar to Japanese yen exchange rate down from around 158.3 to 155.5. But when a central bank does something that aggressive, it introduces sudden, violent volatility across all global currencies.
It's a glaring signal of the extreme pressure that diverging central bank policies and high U.S. interest rates are putting on our global allies.
Completely.
So just wrapping up that overnight picture, as traders were commuting to work in the U.S., they inherited a pape that was deeply defined by gridlock in the Middle East and intense central bank currency defense in Asia.
Which is a really heavy tape to inherit.
It is. We're going to take a very short break, and when we come back, we'll dive right into how the U.S. markets digested all this overnight anxiety.
Stick around.
Welcome back. Let's dive into our next core question. What moved markets during U.S. trading hours?
Well, the short answer is that the overnight anxiety immediately materialized into hard U.S. economic data and incredibly hawkish central bank rhetoric. Right out of the gate, just past 8:01 a.m. Eastern Time today, Federal Reserve officials Hammack, Kashkari, and Logan came out and signaled a highly unified, aggressive shift in tone.
And this wasn't just your typical Fed speak, was it? This was a major pivot.
No, it wasn't typical at all. Kashkari and Logan actually went out of their way to note that they dissented at the recent FOMC meeting. And their reasoning is what's crucial here. They specifically cited the massive inflation shock emanating from those 400 ships trapped in the Strait of Hormuz.
Wow.
Yeah, and then Hammack went on the record stating that the Fed's clear easing bias is simply no longer appropriate.
Just to pause on that for the listener, an easing bias basically means the Fed's default setting is leaning toward cutting interest rates when the time is right. So by stating that bias is no longer appropriate, Hammack is essentially telling the market, hey, do not expect a rate cut anytime soon. The default setting is now on hold, or maybe even hiking.
Exactly. And if anyone on Wall Street doubted why the Fed was suddenly sounding the alarm, the economic data proved them absolutely right just a couple of hours later.
That ISM print, yeah. At 10 a.m. Eastern Time today, the April ISM manufacturing PMI printed at 52.7. Now, the headline number wasn't really the shocker. The true five-alarm fire was buried in the sub-indices.
Oh, the prices paid index.
Yes. The prices paid index surged to a massive 84.6. We really need to unpack how terrifying that number is. The ISM is a diffusion index, right? Meaning anything over 50 signals expansion and anything under 50 signals contraction. So in 84.6 in prices paid means almost every single purchasing manager surveyed across the country is screaming that their raw material costs are rocketing higher.
But here is the kicker. At the exact same time prices were exploding, the employment component of that very same report actually contracted.
Right. Let's make sure this is crystal clear for you listening, because it is an investor's worst nightmare. Normally, if prices are high, it's because the economy is booming, demand is hot, and everyone has jobs. Conversely, if people are losing jobs, demand falls and prices usually drop. Stagflation is this miserable 1970s style scenario where you get the worst of both worlds.
Yeah, the economy is shrinking and shedding jobs, but the cost of living and manufacturing just keeps going up.
It is the textbook definition of stagflation. And that realization completely revived stagflation fears on the trading floor today. It immediately drove the 10-year Treasury yield spiking up to 4.402%.
The bond market was basically throwing a tantrum, screaming that sicky inflation is back and the Fed is trapped.
And the physical economy just kept taking hits as the day went on. By midday, around 11:10 a.m. Eastern Time, the U.S. Treasury announced strict sanctions on any shippers paying tolls to transit the blockaded Strait of Hormuz. And then shortly after that, at 11:50 a.m. Eastern Time, Trump announced a 25% tariff on European Union cars and trucks, which directly hit auto stocks like Ford and Stellantis.
Okay, wait, I have to challenge this right now, Daniel, because this is the core paradox of the day. You just listed a gauntlet of nightmares for the physical economy.
Yeah, it was brutal.
We have blockaded shipping straits, massive new global tariffs, a hawkish Fed threatening higher rates, and a screaming stagflationary ISM print. Yet, despite every single piece of that traditional macroeconomic logic, the S&P 500 actually hit an intraday record high of 7,272.52 today, before finally fading a bit to close near its lows on the futures side.
It makes no sense on paper.
Right. How on earth does that happen? Is the market as a leading indicator just fundamentally broken? Or are traders completely hypnotized by the AI boom to the detriment of the real economy?
That is the million-dollar question. It defies traditional market logic entirely. You have this hot, restrictive, physical world inflation acting like a lead weight, pulling the tape down. And on the other side, you have these incredibly resilient equity indices pulling it up.
So there has to be a counterbalance.
Yes, there is. We're going to take one more quick break, and then we'll dive into our final section to explain exactly how the market survived this.
Be right back.
All right, we are back. So let's look at the corporate events recap and what to watch next. How did the market survive this macro gauntlet today?
Well, the answer lies in what the titans of the energy and tech sectors were doing behind the scenes. They acted as a massive, impenetrable anchor against the macro storm.
Let's start with energy. Before the opening bell at 6:17 a.m. Eastern Time today, both Exxon and Chevron reported their earnings. And if we tie this back to the geopolitical gridlock in Hormuz, there was a very specific nuance in their reports.
Right, Exxon CEO.
Yeah. Exxon CEO noted that offline Middle East production can actually return relatively quickly once the strait is finally reopened.
And that statement acted as a sort of psychological relief valve for oil markets today. It gave traders hope that the supply isn't permanently destroyed, just temporarily paused. However, Chevron provided the counterweight, explicitly warning that global storage buffers are actively running down.
Which is concerning.
Very. The reality is, the longer those 400 ships sit idle, the tighter the physical energy market gets, no matter how fast they can theoretically restart production later.
But if energy was the relief valve, the real superpower holding up the indices today, the reason the S&P 500 hit that record high was the AI government complex.
Yes, this was huge. Early this morning at 7 a.m. Eastern Time, the Pentagon formally announced dramatically expanded partnerships with NVIDIA, Microsoft, OpenAI, Oracle, and several others to utilize their technology for classified AI network.
And this is a foundational shift in the narrative, because later in the afternoon, around 4:39 p.m. Eastern Time, it was also reported that House lawmakers are actively visiting Silicon Valley to discuss AI export controls.
What is happening here is that the U.S. government is cementing the AI infrastructure capital expenditure boom. By securing these massive, price-insensitive government defense contracts for hyperscalers, it completely validates the multi-billion-dollar data center build-outs that have been driving market leadership all year.
It's like we are transitioning from AI as a consumer tech novelty like writing emails or generating funny pictures to AI as critical sovereign national defense infrastructure.
The government is basically putting an unstoppable floor under AI spending.
And speaking of consumer tech behaving like a sovereign entity, we have to talk about Apple.
Oh, absolutely.
Late yesterday at 4:30 p.m. Eastern Time on April 30, Apple issued its earnings. They provided incredibly upbeat guidance, projecting 14 to 17% revenue growth for June. But the headline that truly matters for market structure is that they officially abandoned their famous net cash neutral capital allocation target.
This is a massive paradigm shift that explains so much of today's resilience. For years, Apple's financial goal was to perfectly balance its mountain of cash with its debt and share buybacks, so they effectively netted out to zero. It was an efficiency target.
Right.
By publicly abandoning that goal, they are essentially proving that mega-cap balance sheets remain an absolute fortress. They generate so much free cash flow that they're deciding to just hoard a mountain of cash.
Exactly. It's like the Fed is turning up the gravity in the room with high interest rates to pull everything down, but these mega-cap tech stocks are walking around in anti-gravity boots.
That's a great way to put it.
Because they generate their own cash flow and sit on billions, they don't need to borrow money from the banks. They are totally insulated from the very credit tightening the Fed is trying to engineer. In fact, they earn huge interest on that cash pile.
Precisely. They operate in a completely different financial reality than, say, a small manufacturing company struggling with an 84.6 prices paid on the ISM index.
Well, folks, Apple is officially giving up its net cash neutral target, which is fitting because the only things hoarding more assets right now are the 400 ships trapped in the Strait of Hormuz. We also learned today that the Pentagon is expanding its AI network, presumably to help the Fed figure out its monetary policy, since Kashkari and Logan clearly can't agree on whether to hike or cut. Plus, if you drove a European car to work today, Trump just announced a 25% tariff, so you might want to ask the Bank of Japan to secretly intervene on your commute home.
That would be nice.
It was a wild, stagflationary roller coaster of a session, but somehow tech stocks still found a way to survive the ride. Have a great weekend, and remember to always check your portfolio before you check the geopolitical headlines.
Good advice. And looking ahead to the next 24 hours, there are a couple of key data points you absolutely need to watch to see how this narrative evolves. Keep an eye out for the 1 p.m. Eastern Time Baker Hughes U.S. oil rig count.
Right. Given the extreme tightness Chevron warned about in the Hormuz blockade, domestic production numbers are going to be vital.
Exactly. Then at 3:30 p.m. Eastern Time, we get the CFTC weekly positioning update for crude, gold, the S&P 500, and the Nasdaq 100. That report will peel back a curtain and show us exactly how institutional traders are placing their bets after the violent volatility of today's session.
It'll be fascinating to see. As we wrap up this deep dive, we want to leave you with a larger, almost philosophical concept to mull over this weekend. Based on everything we've unpacked today, it really feels like we are currently watching two entirely different economies try to coexist.
Yeah, on the same planet. On one hand, the physical economy is choking. It is struggling with blockaded straits, massive tariffs, disrupted supply chains, and sticky stagflation.
But on the other hand, the virtual economy of AI infrastructure operates like an unstoppable independent cycle, funded by these fortress balance sheets and massive government defense contracts.
It is the defining tension of this market right now. One reality is bound by physical logistics and interest rates. The other seems completely immune to them. The ultimate question for the rest of 2026 is, which one ultimately bends to the other?
Thank you so much for joining us on this deep dive.
It's always a pleasure to unpack this with you.
Drop a comment below and let us know which of these two economies you think will ultimately win the tug of war.